Hello and welcome to this Croner eCPD module from Paul Davis on the corporate loss restriction and its proposed extension to capital losses. For ease of reference, we will refer to the overall loss restriction rules as the CILR, including their application to both income and capital losses. The module is centred around a case study which illustrates how the corporate loss restriction calculations will look after they've been extended in scope to include capital losses. The extension to capital losses should be effective from 1st April 2020, subject of course to enactment of Finance Bill 2019. The numbers presented in the case study have been chosen to highlight each of the four main statutory provisions that can lead to a restriction under the CILR. Whilst the actual scenario presented may be somewhat unrealistic, the chosen numbers provide an easy-to-understand benchmark against which to compare and contrast the resulting position after the restriction has been applied. We will start by providing some background to the CILR. Next, we will present the underlying case study assumptions. In the third and principal part of the module, we will run through the required CILR calculations in some detail. We will then finish by drawing together some conclusions on basic tax planning in relation to the CILR. The original CILR, often referred to as the Corporate Income Loss Restriction or CILR, was effective from 1st April 2017. It was introduced as part of a package of corporate loss relief measures. The other measures generally increase the flexibility with which carried forward losses can be used. The CILR, in contrast, reduces the amount of carry-forward losses that can be relieved in later periods in certain circumstances. Generally speaking, all standalone companies and groups are given a deductions allowance of £5 million, and all carried-forward losses are deductible in later periods up to the value of that deductions allowance. But for profits above the £5 million allowance, only 50% of those profits may be relieved by carried forward losses. And this, in a nutshell, is the essence of the CILR. So, for a standalone company with current period trading profits of £20 million and £20 million of trading losses carried forward from earlier periods, the maximum permissible deduction for the carried forward losses is £12.5 million. This is the company's deduction allowance of £5 million plus 50% of the company's profits over and above the deductions allowance, i.e. £5 million plus 50% of £15 million. Capital losses were originally outside the scope of the CILR, but it is now proposed that they should be brought within the scope from 1st April 2020. This is subject to enactment of Finance Bill 2019-20. The following case study illustrates how the CILR calculations will look once capital losses have been brought in scope. This slide presents our case study assumptions. We have assumed that a standalone company has a current period trading profit of £60 million and brought forward trading losses of £60 million. It has a current period loan relationship non-trading credit of £50 million and a brought forward loan relationship non-trading deficit of £50 million. Finally, it has current period chargeable gains of £40 million and brought forward capital losses of £40 million. In the absence of the CILR, it can be seen quite easily that the company would have net current period taxable profits of exactly zero, and of all of its brought forward losses would be fully relieved in the period. Note that the brought forward trading losses are assumed to be pre-1st April 2017 trading losses. This means they can only be relieved against trading profits of future periods. Likewise, the brought forward loan relationship deficit is also pre-1st April 2017, so this can only be relieved against non-trading profits of future periods. Finally, the capital loss can only be relieved against chargeable gains of later periods, regardless of when the loss arose. Continuing our look at the case study assumptions, we have also assumed that the company has current year losses which are capable of being relieved against total profits of 50 million. In the circumstances of this case study, these losses could not be trading losses because we have already seen the company has made a current period trading profit. They could, however, be an intangible fixed asset non-trading loss of the current period without being inconsistent with any of our other assumptions. We saw in the last slide that our company would have zero total profits in the absence of the CILR by virtue of brought forward loss reliefs. The current period losses would therefore be unrelieved in the current period in the absence of the CILR and hence available to carry forward in their entirety. We are also assuming that the proposed extension of the CILR to capital losses has taken effect as is currently proposed. In practice, that means we are considering post 1st April 2020 accounting periods. Before moving on, it is also important to note that for simplicity, our case study only considers the position of a standalone company. Whilst the CILR does in fact permit the sharing of its £5 million deductions allowance between members of a group of companies, these rules are outside the present scope. This slide illustrates how the computation of the company's total profits would look in the absence of the CILR. As you can see, total profits in the absence of any restrictions are exactly zero because the trading profits of 60 million would be relieved by the 60 million brought forward pre-1st April 2017 trading loss. The non-trading credit of 50 million would be relieved by the brought forward pre-1st April 2017 loan relationship non-trading deficit of 50 million. And the chargeable gain of 40 million would be relieved by the carried forward capital loss of 40 million. In this example, all the carried forward losses would be fully used in the current period in the absence of the CILR. The following slides will illustrate how this basic position is modified by the CILR. The starting point is the calculation of modified total profits. This modification is required because we need a consistent and comprehensive measure of profits which takes account of all sources of profit for the year. The total profits figure calculated on the previous slide has already been reduced, however, by the loss reliefs that are deductible before arriving at total profits. Consequently, the total profits measure understates the true amount of profits that should be subject to the CILR. We therefore need to add back to total profits the £60 million of brought forward trading losses which have already been deducted in arriving at that amount. Likewise, we also need to add back the £50 million of brought forward non-trading deficit and the £40 million of capital losses, because these too are deducted before arriving at total profits. Adding back these loss reliefs gives us the modified total profits measure of profitability. You can see from the slide that modified total profits in our case study amount in total to 150 million, made up of trading, non-trading and chargeable gains amounts of 60, 50 and 40 million respectively. Please note that there are a number of other technical adjustments required by the legislation in order to arrive at modified total profits, but these are beyond the present scope. A full list of all required adjustments can be found at CTA 2010, section 269ZF. See subsections 3 and 4 in particular. In the same way that total profits sometimes understates the true amount of profits subject to the CILR, the modified total profits measure outlined on the last slide can sometimes overstate the true amount. This is because most reliefs for current year losses are deducted after the total profits measure and not before it. So current year loss reliefs, like the 50 million in our case study, are not accounted for in the modified total profits measure. To address this issue, a further adjustment is required to reduce modified total profits for any current year losses which are deductible after total profits. The resulting profits measures are called qualifying profits and are listed on the slide. For this purpose, the Step 2 amount must be deducted from modified total profits. The Step 2 amount includes, for example, a current year trading loss deductible from total profits, but could also include a current year intangible fixed asset non-trading loss, as in the present case study, or a current year post 1st April 2017 loan relationship non-trading deficit, or current year management expenses, or it would also include group relief claimed from another group company. The key point to remember about the Step 2 amount is that it can be allocated entirely at the company's discretion to the different income streams shown on the slide, and this introduces an element of planning into the process. In our case study, you can see from the slide that all of the current year intangible fixed asset non-trading loss of 50 million has been allocated to trading income. We next subtract the deductions allowance of £5 million from qualifying profits to arrive at relevant profits of £95 million. So, for example, relevant trading profits is equal to qualifying trading profits less that part of the deductions allowance that the company allocates to trading profits, and so on. In much the same way that the Step 2 amount on the previous slide could be apportioned between income streams at the company's discretion, so too can the deductions allowance be allocated at the company's discretion to one or more of the different income streams which make up qualifying profits. As you would expect, however, it is not possible to reduce any of the relevant profits figures below zero. In the slide you will see that the deductions allowance has been allocated in its entirety to the chargeable gains income stream. This reduces qualifying chargeable gains of 40 million to arrive at a relevant chargeable gain of 35 million. As an alternative, the deductions allowance could equally well have been allocated to any combination of each of the separate income streams. This is now a convenient time to take a more detailed look at the four principal statutory provisions which impose the corporate loss restriction. As we mentioned earlier, there are four main provisions which impose the restriction, all of which can be found in Corporation Tax Act 2010. The first, section 269ZB, applies to losses which can only be relieved against trading profits. So, remembering that post 1st April 2017 trading losses can be relieved, subject to qualifying conditions, against a company's total profits, this means that the section 269ZB restriction generally only applies to pre-1st April 2017 trading losses. In theory, it could also apply to a post-1st April 2017 trading loss, if that loss failed the qualifying conditions for relief against total profits. The second provision, section 269ZBA, will, subject to enactment, impose the corporate capital loss restriction currently proposed in Finance Bill 2019-20. The proposed commencement date for the capital loss restriction is 1st April 2020, but this could, of course, be subject to change. The third provision is section 269ZC. This restricts relief for pre-1st April loan relationship non-trading deficits. These, it will be remembered, can only be relieved against non-trading profits of later periods. The final provision is section 269ZD. This section applies to a number of different types of losses, the key feature of which is that they are deductible against a company's total profits. These are referred to in the legislation as relevant deductions. The next slide will consider the order in which the restrictions must be applied. To determine the order in which the four CILR restrictions must be calculated, we need to understand the order in which unrestricted losses must be deducted. Unrestricted losses in this context means losses potentially within the scope of any of the four CILR restrictions, but which in practice fall to be included in the allowable amount. For non-trading losses, those within section 269ZC, we need to consider both loan relationship non-trading deficits and capital losses. Of the two, the legislation requires that unrestricted capital losses must be deducted first, and that any unrestricted loan relationship non-trading losses can only be deducted after the capital losses have been relieved. So, if capital losses account for the whole of a company's allowable losses under the CILR, This means that no deduction will be permitted for any brought forward loan relationship non-trading deficit. In a similar manner, losses allowable against total profits, those within the scope of section 269ZD, that is, can only be deducted after first deducting any unrestricted losses allowable under any of the other 3 restrictions. In practice, this means that the chargeable gains allowable amount must be calculated before the non-trading income allowable amount. Then, the allowable amount for trading losses relievable against trading income and the allowable amount for loan relationship non-trading deficits must also be calculated before the final allowable amount for the relevant deductions can be determined. The graphic on the slide illustrates this interrelationship. We will now look at each of the CILR restrictions in turn, starting with that for trading losses relievable only against trading income. As already mentioned, these are pre-1st April 2017 losses, or post-1st April 2017 losses that do not meet the full range of conditions for a deduction against total profits. Post-1st April 2017 losses that do satisfy the conditions for relief against total profits would fall within section 269ZD, restriction for relevant deductions. The starting point is 50% of relevant trading profits. To this we add the trading profits deductions allowance to arrive at the relevant maximum, which is the maximum amount of these losses that can be relieved against trading profits. Remember that the overall deductions allowance of 5 million can be allocated at the company's discretion for each of the individual income streams. In our case study, 50% of relevant trading profits is 5 million. The trading profits deduction allowance has already been given a 0 allocation by the company, therefore the relevant maximum is also 5 million. There are 60 million of brought forward trading losses available for relief against trading profits. This means that the maximum permissible deduction is not restricted by the size of the available carry forward losses and is therefore £5 million. A very similar process applies for the calculation of the capital loss restriction. The starting point is 50% of relevant chargeable gains, to which we add the chargeable gains deductions allowance. The resulting amount, also referred to as the relevant maximum, is the maximum amount of capital losses that can be relieved against chargeable gains. In our example, 50% of relevant chargeable gains is 17.5 million. The chargeable gains deductions allowance has already been set by the company at 5 million. Therefore, the relevant maximum is 22.5 million. Although there are 40 million of capital losses brought forward for relief, only against chargeable gains, the maximum permissible deduction can only be 22.5 million. Next, we determine the maximum permissible deduction for loan relationship non-trading debits, deductible only against non-trading income. This proceeds in a similar manner to the previous slides, but first it is necessary to aggregate chargeable gains and non-trading income profits. Likewise, it is also necessary to aggregate the chargeable gains deductions allowance and the non-trading income profits deduction allowance. Where circumstances permit, this aggregation process allows loan relationship deficits to be relieved against chargeable gains and capital losses to be relieved against non-trading loan relationship deficits, as one would expect. The slide sets out the calculations required, starting with aggregation of the chargeable gains and non-trading income profits deduction allowance. In the case study, you will see that the total non-trading profits deductions allowance is £5 million. This is deducted from qualifying non-trading profits, both income and gains, to give total relevant non-trading profits of 85 million. The relevant maximum here is 47.5 million, being 50% of that amount plus the non-trading profits deduction allowance of 5 million. The difference here is that any actual relief given for capital losses within, but not actually restricted by, the capital loss restriction, 22.5 million in this example, must first be deducted from the relevant maximum to give 25 million maximum permissible relief for non-trading income profits. In the case study, this is not limited by the size of the 50 million available brought forward losses, so the actual relief claimed for pre-1st April 2017 LRNTDs brought forward is 25 million. We can now complete our calculations by working out the maximum permissible relief for relevant deductions, i.e. relief for brought forward losses that are deductible from a company's total profits. We start with the total relevant profits across all types of income and gains of 95 million. 50% of this is 47.5 million, to which we add the total deductions allowance of 5 million, giving a relevant maximum of 52.5 million. From this we must deduct any actual reliefs claimed in relation to unrestricted losses falling within the scope of all the previous CILR restrictions. So in the slide we need to deduct the actual £5 million relief claimed for pre-1st April 2017 trading losses within the scope of the section 269ZB restriction. We must deduct the 22.5 million of capital losses within the scope of the section 269ZBA restriction, and we must also deduct the 25 million of actual relief claimed for loan relationship non-trading deficits within the section 269ZC restriction. The amount is 0. Therefore no relief could have been claimed for relevant deductions had there been any in the case study example. This completes the detailed CILR calculations, so we can now end with the final picture of the company's taxable profits across all different income streams. Take some time to familiarise yourself with the final position. You will recall that in the absence of the CILR, all 150 million of carried forward losses would have been fully relieved in the current period, and all of the 50 million current period losses would have been carried forward to later periods. The key to any tax planning associated with the CILR is threefold. Firstly, the identification of any loss types that the company would like to use in priority to other losses, e.g. our company may not expect to generate any future chargeable gains, so it may be its priority to relieve the brought forward capital losses in priority to other losses. Secondly, to understand the elements of discretion permitted under the CILR calculations. These are 1. The allocation and deduction of the Step 2 amount to modified total profits, as shown on slide 8. 2. The allocation of the company's deductions allowance between the trading, non-trading income and chargeable gains deductions allowances. And thirdly, the sharing of the deductions allowance with other group members. These amounts can be allocated at the company's discretion, and therefore an element of planning is introduced. Thirdly, we need to remember all of the usual loss planning techniques, in particular the need to claim or the ability to disclaim loss reliefs as appropriate. The available combinations of claims and disclaimers may, depending on the circumstances, allow companies further scope to alter the manner in which the CILR will apply to its own unique set of facts. We have now reached the end of this module, and you'll soon be able to test your understanding in a short quiz. The first key learning point is the background to the CILR and its proposed extension to capital losses from 1st April 2020, subject to the enactment of Finance Bill 2019-20. Next, you should understand that the choice of the case study calculations was designed to showcase all aspects of the operation of the statutory rules. Many real-world cases may be much simpler. Part 3 of the module contained the detailed calculations. If you intend to advise companies in relation to the CILR, there is simply no excuse for anything other than a comprehensive understanding of how the calculations are performed. Finally, our conclusion looked very briefly at the scope for basic tax planning within the framework of the CILR calculations. I trust you found this module informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you've completed the quiz, you'll be able to print out your personal certificate. The module homepage also contains a link to the notes that accompany this module and to further resources available to you from Croner. Goodbye, and thank you for using Croner eCPD.
For further information and to view the full range of Croner eCPD modules, visit our website at croneri.co.uk.